Welcome to Investors Insights, where today's topic is Fed cut. Now what? A lot to talk about today. We finally got the Fed cutting rates last week. A lot of impact on a Fed rate cut, and we'll discuss that today. I'm going to discuss the impact of lower rates on housing. Ty's going to talk about the impact on corporate earnings. But first, Trey, what does history say about a rate cut?
Yeah, thanks, Bobby. So in last week's vlog, we talked about once the Fed changes course and goes from a pause or a hike to cutting, there's two paths. The economy, the Fed either continues to cut into a slowing economy that's going into recession and is trying to follow the economy down and catch up and provide support to a weakening economy, or there's what's called a soft landing, where the Fed cuts a couple times, then can stop because the economy is not going into recession and rates are not having a negative impact on growth. So we have soft landing on one hand and recession in another. And so looking back at history, since 1990, there have been 7 instances where the Fed has cut rates after either a pause or a rate hiking cycle. And in the majority of those cases, it was 25 basis point cuts in 2019, which granted went into a recession, but that was COVID. That happened in 2020. They started with 25 basis points. In 1998, 25 basis points. In 1995, which is the most famous soft landing, where the maestro Alan Greenspan orchestrated a drop in inflation without recession, they did a 25 basis point cut. And then in 1990, we had a recession, but it wasn't terribly extreme, and it kind of took a little bit with Gulf War I. They started with 25 basis points. In 2001 and 2007, and then in March of 2020, the Fed started with a 50 basis point cut. And then in this cycle, the Fed cut 50 basis points. So the Fed is putting out there that the economy is not slowing. There's no current news that we're in a recession. And so there is a little bit of concern. The markets definitely are higher and enjoyed that 50 basis point cut because it does help a lot of industries. But there's this group in the economic industry that's kind of concerned. What does the Fed know potentially that we don't know? Why did they start with a 50 basis point cut? History tells us that that's not normal. And when they do that, it's because they have a good reason and they're trying to get out ahead of potential slowing economy. Something we're watching closely. It's our research partners at Strategas are pointing to what could lead to a soft landing, and we've talked about it on this vlog over the last couple of years that we've kind of had rolling recessions. We haven't had an economic wide recession, but we had certain weak points. We had strong goods orders during COVID that then transitioned into strong services post-COVID as people wanted to get out. We've been living on experiences and dining out and travel. That is really what's been driving the economy. And that's kind of run its course. And we really need this handoff from a service-oriented growth economy to one that's driven by the areas that have been weakened, which is manufacturing and housing. Both those are capital-intensive industries, and capital-intensive industries will be held by a cut rate. So maybe the Fed is saying, we want to orchestrate this handoff. Let's boost the parts of the economy that are weak. And that's why they did 50 basis points. So time will tell, but that's what we're looking at right now.
Yeah, something we've got to watch closely here. And a common topic that has come up in a lot of meetings the past 12 to 18 months is housing. Obviously, the housing market has been negatively impacted by higher interest rates. So now that the Fed has actually started to cut rates, we're being asked what happens with the housing market now. And the good news for the housing market can be seen in these charts that actually shows early signs that the U.S. housing market is already starting to improve. And so the first chart here shows U.S. mortgage applications turning higher with recent mortgage rates falling. And you can see the big impact that higher rates have had on the mortgage business seen in this chart. It goes back all the way to 2022. So obviously, it's great to see early signs of an uptick in weekly mortgage applications. This should bode well for the housing market in the coming months. And the next chart here on the left shows a big jump in U.S. housing starts, rising 9.6% month over month in August. That's a big one-time jump. And the chart on the right here shows an uptick in housing permits. We follow housing permits closely because permits are an economic leading indicator that we follow. And so these charts and the positive trends that we're seeing are showing us that there is a pent-up demand in housing, which should lead to a healthier housing sector, which historically leads to a healthier overall economy. That's why we're watching housing carefully here. And then, Ty, again, we finally got a rate cut. Continue talking about the impact of lower rates, more specifically on corporate earnings.
Yeah, and I'll start with kind of how it reflects on the market as well. And so, of course, we got the rate cut, and the market really took that in stride. Market rallied on that day, and then kind of sold off later in the afternoon because it's a lot of why did you cut? Kind of talking points there. You want to make sure that you're cutting for good reasons and not because of an economic slowdown. And so that's things that we'll be able to evaluate as time goes on. But we did just get through the second longest Fed pause of all time. It was about 420 days roughly. The previous or the longest is 2006, 2007, which of course preceded 2008 and 2009 great financial crisis. I'm not saying that that's what's happening here, just kind of an interesting note, but rather a long pause. Typically, the pauses are more in the 150-day range, and ours is 420 days here. And so kind of looking at market performance 65 days leading up to a cut and then 65 days after, you can see in this chart, 65 days prior, it's usually about a 2% kind of gain. And then 65 days after, down about 1.5%. And then I also want to share this chart, which we've been over a couple times. And so leading up to the first cut, as you can see, the market kind of, usually rallies a little bit. We see roughly a 5% gain in just 100 trading days. But then after the first cut, typically takes the market a little bit longer to bottom. We see a sell-off, and then typically about 200 days later, we hit that low. And so again, these are just things that we want to kind of keep perspective on. I think there's a big sigh of relief when you see a first cut come, and just want to kind of make everyone aware that typically a lot of the market gain is made in the pauses. And so that's something that we're going to keep an eye on. It doesn't have to be that case. We've had outliers before where after a cut, the market has been up. And so we want to evaluate each situation individually. And then maybe the most interesting aspect I've seen is we're expecting record earnings next year of roughly $280 for the S&P, and that's going to require record margins. But according to this chart here, 12 months after the first cut of a Fed cycle, earnings usually down 10%. And so it's interesting that we're expecting next year record earnings, but typically earnings are down 10% after the first cut. And so that's something that we're definitely going to keep an eye on. I think that is going to be something that's going to be key moving forward to see if we actually get that record earnings, or see if the cut really prevails and earnings get hit a little bit.
Yeah. So again, Fed cut, now what? We'll continue to keep you updated on the impact that lower rates are going to have on the economy, housing market, corporate earnings, and the market. So if you have any questions about anything we've discussed, call us, email us. We love your feedback, and thanks for watching.